So in this video today, guys, I'm going to be sharing with you why I believe the stock market is rigged right now or being artificially propped up by a couple of different factors. Because right now, the stock market is on an absolute tear, and the Dow has had its best two-week rally in over 80 years. Meanwhile, the underlying economy itself is not doing well at all. We are seeing rising unemployment, the oil prices are crashing, and in general, all of these red flags are flashing warning, and it seems like the stock market is ignoring it and just doing its own thing, which could be evidence that the stock market could be rigged. Now, I just want to mention, guys, this does not mean that you should go out there and sell all of your stocks or buy a bunch of stocks. In fact, you should probably do whatever you're going to do ordinarily, not making any drastic measures based on this video. And lastly, guys, I am not a financial advisor. This is not financial advice. This is merely my opinion of what is going on and nothing but that. So you should always do your own due diligence before making any kind of investing decisions. But anyways, guys, this storyline does get pretty complicated, but I'm going to try to explain it as simply as possible so everyone can follow along. So the very first thing that we are noticing that we already talked about is this deviation between the underlying economy and the stock market. Generally speaking, when the economy is not doing well, the stock market should not be doing well. Now, we are seeing massive economic factors showing us that we are potentially entering a recession, or we may already be in one, but instead we are seeing the stock market climbing higher and higher week after week. And this quote here by Amy Kong, who is the Chief Investment Officer at Barrett Asset Management, explained this very well. She said, "While it's great to be in the green, we do wonder, what is it that the markets are celebrating?" And that's essentially the point I'm making right here. Why is the stock market going up when all of these major economic factors are flashing warnings of entering a recession? What is going on behind the scenes? And one of the key contributing factors is the fact that the Federal Reserve is stepping in like never before and taking actions that have never been taken before in order to prop up the market and protect corporations and overall hold up the economy. Now, there have been multiple actions taken by the Fed in response to the pandemic and the potential recession we are entering, but the focus on this video specifically is going to be on the purchasing of bonds. And if you're not familiar with what a bond is, guys, it's essentially a way for an entity like a business or a government to raise capital by issuing debt, and investors purchase those bonds and earn, in most cases, a fixed rate of return over a set period of time. Now, the Federal Reserve has already stepped in and started purchasing municipal bonds in order to help local governments and states that are suffering as a result of this pandemic and allowing them to have access to financing. And they've also performed asset swaps with the big commercial banks by purchasing treasury bonds and mortgage-backed securities, essentially freeing up liquidity for the banks. That is nothing out of the ordinary because this is something we see anytime that there is a major economic crisis. But now the Federal Reserve is doing something they have never done before, and it could be propping up the stock market as a result, and it has to do with a number of these large US companies that have been deemed fallen angels. And these are essentially these massive American iconic companies that have been around in some cases for 100+ years that have been severely impacted by the global pandemic and as a result are under serious financial hardship. And one example of this that we're going to be using and looking at in this video is Ford. So what exactly is the federal government doing with these companies? Well, let's get into that right now. So a couple of weeks back, guys, Ford had to shut down their North American factories due to the spread of the virus. And we finally got an idea of just how bad this crisis has been for them in their Q1 earnings report, where they reported losing $2 billion. Now, Ford does have some cash on the sidelines, and they're not about to go bankrupt, but they needed to raise more capital in order to stay afloat and have a longer lifeline. And during this, as a result of the shutdown of factories and this massive loss, Ford's credit was downgraded to junk status. Now, if you're not familiar with what that means, guys, this is just like your own credit score, where some people have an excellent credit score, some people are good, and some people are poor, and the rate at which you can borrow money is based on that credit score. So companies with a higher credit rating are able to borrow money more cheaply, and companies with a lower credit rating have to pay more in interest in order to borrow money. Now, when it comes to corporate bonds, you have both investment grade bonds and then a different category considered junk bonds, and that is based on the credit rating or credit worthiness of that individual borrower. And the downgrade of Ford pushed them out of investment grade bond status and put them into junk bond status. Now, an investment grade bond is considered to be a sound investment where there is minimal or low risk, and there's a very small chance of that borrower defaulting on their obligations or not paying back. However, when you get into junk bond territory, it becomes far more speculative, and it's unknown whether or not this borrower will be able to pay back that debt. And as a result of this pandemic, numerous massive American iconic companies have been pushed into junk bond status based on these downgrades. And that list includes Delta Airlines, Macy's, Gap, and Pemex, and there are also dozens of different companies that are right on the edge at the very bottom of investment grade status, where just by being downgraded would be pushed into this junk bond status. And that list of companies right on the edge includes Marriott, Hyatt, Molson Coors Beverage, as well as Hess. So these are massive companies that are very important to our overall economy that, as a result of this pandemic and maybe what is going on with them financially beforehand, are now being pushed into junk bond territory. And the problem is, when they're in this junk bond territory, it is very difficult for them to basically get reasonable financing when they are issuing bonds. It's kind of like going out there and looking for a credit card. When you have a credit score of 600, the interest rate is going to be astronomical. So what tends to happen with these companies is they are forced to issue bonds at very unattractive interest rates in the double digits, and then as a result, they're basically burning the candle at both ends. They can't afford to stay afloat, so they issue bonds, and then the amount of money they have to pay in interest servicing those bonds puts them under even more financial duress, which essentially just turns a bad situation into a worse situation. So in a nutshell, guys, I know the bond rating gets a little bit confusing, but all you have to understand is it's like the credit score for businesses, and a company like Johnson & Johnson has an excellent credit score or credit rating, and so they can borrow money a lot cheaper than it costs Ford to borrow money or issue bonds. So we ended up with this crisis here where these large companies did not have access to sound financing at reasonable interest rates because the interest rate for these bonds on the free market would have been sky high based on being in junk bond territory. So essentially what we had happen here is the Federal Reserve, for the first time ever, has crossed the line from purchasing municipal bonds and treasuries to now purchasing corporate bonds, and in particular, they are purchasing these junk bonds of these fallen angels, these large companies that are in serious financial duress as a result of this pandemic. So back to the example of Ford here, we know they lost $2 billion in the first quarter, so as a result they issued bonds in the amount of $8 billion, and it's very interesting to look at the terms of these bonds because they are more attractive than what Ford would likely be able to get issuing bonds on the free market that would be purchased by investors. So Ford ended up issuing 3 different series of bonds. The first series, totaling $3.5 billion in principal, would have an 8.5% interest rate and mature in April of 2023. The second series of bonds was $3.5 billion with an interest rate of 9%, maturing in April of 2025, and the third series was $1 billion in bonds at an interest rate of 9.625%, maturing in April of 2030, and all of these bonds are unsecured, meaning that Ford did not have to put up any kind of collateral in terms of assets backing these bonds. And the important thing to understand here, guys, is that Ford would not ordinarily be able to have access to this type of financing and these interest rates with no collateral under normal market conditions, and they are only able to do so because the Federal Reserve is backstopping these companies and essentially propping them up by giving them sound access to capital at reasonable interest rates. Now, you might be asking yourself, how exactly does the corporate bond market have anything to do with the stock market? But they are very closely related. And so here are the different ways that this could be rigging the stock market, or inevitably leading to something that could be even larger, which could seriously be affecting the stock market. All right, so the first reason here, guys, is simply the capital. The fact that these struggling companies are now able to have access to reasonable financing is looked at as a positive. And an example of this here, guys, is that on the news that the Federal Reserve was backstopping these fallen angels, Ford stock surged that day. So when the federal government begins interfering with the bond market and purchasing these corporate bonds, these companies are going to have a more positive financial outlook, which will in turn result in a higher stock price as investors are more willing to purchase shares of that company. For example, if you're a Ford shareholder and then you hear about them being able to secure, good financing, it's looked at as a positive among investors. So as a result here, the Federal Reserve purchasing these corporate bonds is almost certain to increase the price of the stock for these companies as it improves their financial situations. And where this becomes a problem is the fact that the Federal Reserve has an infinite supply of money because they're essentially printing it out of thin air. It's not like an investor, at a bank or somebody like me who has a fixed amount of money to invest. The Federal Reserve has an infinite amount of money that they can pump into the market. So in a nutshell, based on what is going on here, the Federal Reserve could pump billions of dollars into the corporate bond market, which could artificially inflate the stock market because it's essentially money that is coming out of thin air and not true investment capital that is entering the market under normal conditions. Now, it's important to remember here, guys, that these are bonds that they are purchasing and these corporations will have to pay them back. It is not like a grant where it's free money, but it is important to understand that these terms are far better than the free market would command based on the risk associated with these investments. The second part here, and the biggest component to this, is the fact that there's a very fine line here between purchasing bonds and then purchasing equities or stocks. We have already heard from the Federal Reserve, and we know that they have said that nothing is off the table in terms of propping up the economy. We also have a president going into an election year, and one of the biggest pieces of his campaign was the bull market. So he is in a position where he would do just about anything possible to prop up the stock market and keep the prices high. And it's not unforeseeable that the federal government could initiate policies that would allow them to pump money into the stock market, buying equities or stocks, which would artificially inflate the stock market, pumping up the economy. So if the stock market continued to deteriorate and there was massive selling going on causing prices to fall, the Federal Reserve could step in and begin doing mass purchases of ETFs or exchange-traded funds, and that is essentially a way to purchase the stock of hundreds or thousands of different companies. So if the prices began to plummet, the Federal Reserve could step in and pump an infinite amount of money into the stock market, artificially creating demand for it and propping up the price. Now, based on the current laws, this is not something the Fed is allowed to do, and it is not going on right now, so they would need permission from Congress in order to begin purchasing equities, but it's not a very far-fetched idea at all, and some economists expect that this is very likely to happen, especially because we have seen them for the first time ever purchasing corporate debt. And lastly, this type of government involvement leads to point number 3, and that is where we have an unreliable stock market in terms of an indicator of values of companies. Because in a free market condition like we have with the stock market, The buying and selling demand of a given stock tells us what the price per share is, and this is very important information that we all use when making our buying and selling decisions and evaluating companies. If the government was pumping money into the stock market, you would no longer be able to consider that as a reliable indicator because the prices would be artificially inflated. Not to mention, this would also lead to less people short selling, and that's a little bit more complicated, but that is people who are betting against a stock or the market, and they essentially make money when the prices fall. Well, the short sellers would no longer be in a fair position because even if the market was tanking, the Federal Reserve would be able to step in and artificially prop up the economy, making this a rigged game for them where it is not fair. So as a result, you would see less short selling or less people betting against the market, which could be looked at as another false positive when you look at the percentage of short selling based on people who are going long in a given position. And that gets a little bit more confusing here, guys, but essentially the main point I'm making here is the market would no longer be a reliable indicator, and this would deter short selling, which would create another false positive about a good market. So in a nutshell, guys, to explain this as simply as possible, the Federal Reserve has made it clear that nothing is off the table, and evidence of this is the fact that for the first time ever, they are stepping in and buying corporate bonds, in particular, the junk bonds of these fallen angels. And these bond purchases are propping up these companies, which is affecting the overall share price because it improves their situation financially since they are able to access reasonable financing. And essentially, there's a very fine line between the US government purchasing corporate bonds and then the US government purchasing corporate equity or stocks. Now, based on the current laws, the Federal Reserve is not able to purchase equities, but many economists believe this is a very strong possibility that laws will change and they will be allowed to do this in the future, and this is something that they may do. And while it may sound like a positive, most people would agree that the government stepping in and buying up stocks is in general a bad idea because it interferes with the free market and it no longer makes the stock market a reliable indicator of demand. And this would essentially deter short selling because they don't want to fight the Fed, as they say, and it is no longer a fair game where they have a shot of winning, again, producing another false signal by lowering the amount of short sellers in the market. Now again, guys, I just want to restate this does not mean you should go out there and sell a bunch of stocks or buy a bunch of stocks or really do anything at all. It is just important to understand what is going on behind the scenes, how this bond purchasing is influencing the stock market, and what could be down the road ahead. So anyways, guys, that is going to wrap up this video. I hope you enjoyed it. Let me know what you think about this down in the comment section below. If you agree with this or disagree with this, I would love to hear what you guys think. If you guys are interested in getting 2 free stocks, Webull is currently running a promotion where if you open a brokerage account with them, you're going to get 1 free stock just for signing up. And then if you fund the account with $100 or more on your initial deposit, you will get a second free stock. So if you guys want to grab 2 free stocks, that's going to be the top link down in the description below. And lastly, guys, I was interviewed on the Millennial Investing podcast a couple of weeks ago, and that interview just went live. So if you guys want to hear that interview where I talk about investing in the stock market as well as starting up my YouTube channel as a side hustle and then quitting my job and doing that full time, that interview is also down in the description below. I would highly recommend checking it out. But thanks so much for watching, guys. Subscribe and hit that bell if you haven't already, and I will see you in the next video.